The COVID-19 pandemic is set to burden the already burdened Indian banking system with more non-performing assets or NPAs. With the financial system facing severe strain already, two veteran central bankers, former Governor Raghuram Rajan and former Deputy Governor Acharya, have come together to identify the key problems in the banking space and to provide solutions. So firstly, what are the problems as they see it? Well, actually, what they point out is that India's debt to GDP, that is private debt to GDP, is only 60%. In many countries, it is over 100%, even over 200%. This gives the impression that banks are lending only to the creamy layer, the rich, in which case there should not be any problem of NPAs. Yet, India has the highest NPAs. Even before COVID, it was 8.5% of total loans. What is worse, even when you want to recover from NPAs, India's record is the lowest at about 25 to 30%. This is bad even in comparison with emerging markets. And even after the IBC, this has come just up to about 40%. So what happens is that you're constantly asking for more capital. And at a time when the government has other demands, it makes sense to run the banks better. I mean, if you're not even lending to everyone and still making bad loans, there is a need to improve banks rather than keep depending on the government for more capital. So they have some solutions, and I'll quickly run through them because we have the guests with us. One very interesting suggestion they make is that for selling legacy loans and more that will come because of COVID, have an online platform of selling bad loans. Another interesting suggestion they make is, of course, that you should have a private and a public sector and or bad bank which will be able to sell loans quickly. That's one. The second solution is, more importantly, improve the working of the PSBs. First, have very independent boards and then slowly wean away government support. That is, actually abolish the DFS, the Department of Financial Services, which oversees the banks, and slowly bring down government stake to below 50%. Also, very strong incentives for the CEOs. That's the second set of suggestions they have of PSB management. And public sector bank ownership, create something called state-linked loans. And this anyway, even state-linked banks, this anyway, even the government has been saying that they don't want more than 4 entities in any sensitive sector to be government-owned. So it looks like they are in a position to listen to this advice of bringing down government stake below 50% and then eventually even reprivatize some banks. These are some of the solutions that they are suggesting. There are more as we go along. But since I have the two eminent authors with me, let me go straight away to Dr. Rajan and Dr. Acharya. Thank you very much, both of you, for joining me in this conversation. Comes at a very critical time, your suggestions. Dr. Rajan, let me first start with you. You know, this indictment of the banks is severe and perhaps warranted. You know, we have not even banked the country properly, and already you have the highest number of NPAs. Is, yes, justified by the numbers, but really, is it really the bankers' problem? I mean, if power companies are not able to collect from their citizens the money, you know, 25-30% is power theft. If courts say, you know, 20 years of coal blocks are to be cancelled, or if they cancel all telecom licenses 2 years after they are given, I mean, this is a soft state. We are not, you know, honoring the sanctity of the contract. Why only pick on the banks?
Well, we don't. I think what we also say is government failure is partly responsible for the pileup of NPAs, certainly at the public sector banking system, which has financed a tremendous amount of infrastructure. So there's plenty of blame to spread, but we also have to start finding solutions, right? And to some extent, we argue that the crisis offers an opportunity which didn't present itself before. And that opportunity is the government has very little money. And the ability to paper over the inefficiencies of the past is much diminished. And so this opportunity, we should try and take it in the best way possible. What we've put together are a bunch of suggestions. I won't claim a lot of originality for each one of them, because they've been said before, some by some committees that we ourselves have set up or run. But really, we're trying to bring together a number of suggestions which, if collectively enacted could make a huge difference. And that's very important. India needs all the growth it can get at this point. It is looking at a very, very damaging pandemic. And so we need to find every reform we can and put it together.
Okay, fair point. I mean, even the banking sector does need reform, and there's no point just blaming other things. Dr. Acharya, to get you in, you know, the sentence from your paper that has made headlines is that you're asking for the abolition of the Department of Financial Services, and even this has been made by other people and other committees. Now, you know, this is the time when every other country is actually fiscalizing even more. And there is a strong demand to ask the government to provide more help. Do you think at such a time this advice will be taken? Or do you think we have to wait for the bringing down of the government stake, removing the DFS? Is this immediately implementable?
That's a good question. See, we have to take care of our initial conditions while we are dealing with the pandemic. Many other countries which are being used as a justification for further fiscalization of our banking sector problems have much more fiscal bandwidth. Their banking sectors are much better capitalized. And they don't have the historical record of every leverage cycle turning into a bust, at least not every single one, even though they had one very recently, 10, 12 years back. So I think the situation we face right now is that we have at least 2 decades, if not longer, of these boom-bust cycle of our public sector banks. It's clear that there is a governance problem in the quality of underwriting of these loans. It's also clear that there are fiscal implications of this, and that we need to break the umbilical cord to whatever dual control has been set up in the finance ministry for this to happen. It was a Department of Banking first, then it became Department of Financial Services, then it acquired a seat on the board of the RBI. This is just mission creep to altering the game so that ultimately it favors, behest lending. So I think, as Dr. Rajan put it, we need all the growth we can muster at this point. Our needs and initial conditions are different than those of other countries. So contrary to where they are headed, because we've already been there, we need to actually sever that knot and actually move forward by making public sector banks better governed, more independent in their functioning, and a lower cost to the taxpayer.
Okay. No, I'm only saying that in terms of sequence, at the moment, there are repeated meetings between the finance ministry and the public sector banks. In fact, all banks goading them to lend, even having outreach events where they can be goaded to lend. So I don't know at the moment if it is a very propitious moment for bringing down stake or removing the DFS. But I'll come to that in just a minute. Since the immediate problem is going to be probably more number of bad loans, how do you solve them? So, Dr. Rajan, first to that, for me, that was a very interesting, and I don't think any other committee has spoken about an online sale of loans. You are asking for codifying or standardizing loan covenants, then also an online sale of loans. Can you dwell more on that? Because that seems something where everyone may agree.
Right. Just to complete the answer to your previous question, I think the point is not so much sort of get rid of DFS, the Department of Financial Services, overnight, but ensure there's a steady transference of its functions back to the bank boards, back to the bank board bureau that was set up by the DFS itself, and ensure that there is very little work for the bureaucracy, that this becomes a more commercially driven enterprise. That is really what we need to do. And obviously, there's a sequence of events which will help that, but it has to be politically driven. What we're saying is the bureaucracy has no incentive to let go of the banks, and this has to be driven politically. Now, to your point about bad loans, this is the problem we're going to face going forward. Yes, you can postpone repayment, you can have moratoria, you can have, have forbearance. But eventually, those loans have to be repaid, and many firms do not have the ability to repay the size of debt they've taken on. This was the case even before the global pandemic, but it's become even more acute given the lockdowns we've had and given the GDP loss we've had. So we need to have structures in place. What we are saying is that we need to think of all possible structures, bring back the IBC into contention for the large loans, for restructuring them, but also think about other ways we can restructure. One of the big concerns sometimes is when you have a big consortium of banks lending to a borrower, the consortium can't get together and agree. There will be many such decisions going forward. So we are arguing that perhaps the consortium has to sell loans to an entity which then can manage the loans on its behalf. It could be the consortium sells out to a single member in the consortium. It could be the consortium sells out to a bad bank. But the problem with bad banks is they don't really know what price to buy at. There's very little price discovery.
Yeah.
And if a public sector bad bank pays too high a price for loans, there's always the fear that it might be subject to inquiries and so on. To rectify that, we need a more liquid market in loan sales, especially distressed loan sales. And that's why we are arguing that as these supervisors push on the banks to deal with the massive amounts of bad loans they have, perhaps that push can result in more loans being sold, but also creating a more liquid market for loans. So there's a benchmark. When a bank wants to sell its loan, it knows typically what that loan has received in the market, and therefore, once it receives that price, it's willing to let go rather than sit on it forever for fear that if it sells at too low a price, somebody starts an inquiry against it.
I don't know what you think is the biggest legacy you have left behind, Dr. Rajan, but I would, as a person reporting on banks, believe that the CRILIC, the database of loans that you set up, is clearly something which has made all bankers more powerful because they know each other's position and who has defaulted where. So, these institutional mechanisms are very useful. That's why I'm asking you to develop a little more, if the RBI is listening to you all. How would you transit from this database of loans? And Dr. Acharya has also spoken in the past. He has made presentations on a public registry. So, Dr. Acharya, maybe you want to give, what is the step the RBI has to take to move from this CRILIC to a public registry of loans and then online selling? Can that happen, say, in a quarter, in 6 months?
I think it can. The public credit registry is, of course, in works. But as you said, for the large corporates, CRILIC is already in place. Loan standardization and registry helps because it reduces the due diligence costs that the potential buyers have to spend in figuring out what exactly are the terms of the loan. So I think that would be the main extra step that would be required to codify the loans so that they can also be recorded in CRILIC. And then you would need to set up an online utility platform. RBI has been actually quite successful in helping develop these kinds of platforms for trading in Government of India securities. And I see no reason why it can't actually play such a coordinating role in developing an online sales platform. Just to mention here that this idea is born out of the experience of South Korea during the Southeast Asian crisis in late 90s. They set up a Korea asset management company, CAMCO, which performed exactly these functions. It collected information about the loans, codified the loans, and provided transparency on the loan sales. Over time, the benchmarks got established for distressed loan sales for the sector as a whole, and in case of some large companies, as to what marks were possible. And this has now become a public utility. And I think this would provide tremendous relief to bankers who fear inquiries being undertaken based on the prices at which they are either marking the loans or selling them on to potential buyers or to a future bad bank.
Okay, well, we are in a state of emergency, so to speak, an economic emergency, given the scale of the problem. You think, Dr. Rajan, this is doable even under such circumstances?
I think it is doable precisely in these circumstances. And this is why I really have been saying again and again for the last 6 months or so, we need to adopt a position of urgency in every government and supervisory and regulatory authority we have. We are facing a tremendous economic emergency over and above the medical emergency we have. And the more we are complacent about this, the worse we will do. We're already doing very badly. Let's get our act together. There is a bad loan problem coming. I'm chairing, along with Mario Draghi, a workforce looking into distress across countries. And the amount of distress in countries that are doing better than India is already overwhelming. To think that India is not going to have a distress problem is just is being overly complacent. We need to get our structures in place at this point.
Now, another interesting structure that you have suggested is tweaking the IBC, that in COVID cases, you allow even the promoter to bid for a loan. I mean, at the moment, if a loan goes into bankruptcy, we don't allow the promoter to bid for it because, obviously, he could be wantonly running it down and then buying it cheap. You're saying that for COVID cases, you allow. That, Dr. Rajan, you think is a very small tweak that should come in handy in a year or so?
Well, we're saying allow on the, based on the sort of permission given by the creditors. One of the worries, one of the reasons promoters were prevented from bidding, which I supported, was the notion that they essentially scare off all other bidders and buy back their loans at a fraction of the sort of value they were supposed to pay back. And that kind of problem was being solved by preventing promoters from bidding. Now we have many more firms in trouble, not because the promoter has run the firm into the ground, but because of the pandemic. And so in this case, it may be the promoter is still the best manager to run the firm, and taking the promoter out may not be warranted by the circumstances. But I would let the creditors judge whether they want to let the promoter bid. And if they collectively feel the promoter can be an important bidder, why not let the promoter be part of the auction? Actually, even before that, it may make sense to just renegotiate the debts with the promoter. A cooperative promoter will agree to some restructuring process, which will allow him or her to essentially pay back a large fraction of the debt, but with some relief. So I think that should be allowed.
Yeah, I think you were among the first to call, I think about 3-4 months back, that the IBC and the NCLTs should be working 24/7, actually in a situation like this. It's a pity that we have postponed that. But Dr. Acharya, do you want to add to this in terms of, how we can handle this stress, loans quickly, how we can be proactive?
Yes, I would say 3 things. First, I want to reiterate what Dr. Rajan said, that we have to look at insolvency and bankruptcy code as a way to restructure the distressed corporate balance sheet rather than just as a punishment to the promoter, because it's not always the case that it's the promoter's fault, and we've got to have the bankruptcy code work for that. So the earlier proviso that the promoter can't come back made sense with the legacy loans. But it may not make sense with the fresh post-COVID defaults that we are seeing. So I would very much push in the direction of getting IBC to work, because it will also be the fallback mechanism for the out-of-court restructurings that banks may want to do. The second suggestion that we are pushing for is this idea of a bad bank. And it can be private in certain sectors where you just need better asset managers and you want these things to get off the bank balance sheets so that they can focus on newer loans rather than on legacy loans. But in sectors such as power, where you might have to mothball assets for a while, it could be that a player such as an NTPC might be a more natural acquirer of some of the assets, or you need to quote-unquote quarantine these assets in a public sector bad bank. Now, of course, that would require some government capital upfront. The last point I would make is that we have seen a lot of movement towards allowing restructuring of loans through the Kamath Committee proposals, etc. But we haven't seen a very decisive movement towards getting banks to be better capitalized for these losses. Large private banks have been raising capital on their own, but I think we have no clarity yet on what's going to be the overall level of capitalization coming out. As Dr. Rajan said, the losses are going to be quite high, and we better have a well-capitalized banking system when we emerge out of COVID.
Yes, there are too many demands on capital, and some recap bonds have been announced. I won't envy the government's position at a time like this. But, precisely that, Dr. Rajan, I want to come back to the privatization or bringing down the government stake. What is a credible plan? Would you want that the Banking Regulation Act be amended right away? And just now amendments have been announced to allow that banks be taken over without moratorium, etc. So quick amendments to ensure that they come under Companies Act and the stake be brought down. Is that the first step that they should do? Bring it below 50%?
Done even without legislation is to strengthen the bank boards and depoliticize them, professionalize them. This is something that could be done by the Bank Board Bureau, give the ability to choose directors for the various banks, the government directors,
Dr. Rajan,
to the Bank Board Bureaus.
I want to interrupt you because that would be really difficult. When your stake is up, about 75% or thereabouts, and, you are amenable to the CAG and the CVC when you are, a government-owned bank. Don't you think that, you can have powerful people only if you bring the stake down? Will it really work the other way around?
But Latha, who appoints the Bank Board Bureau? It is the government.
Yes.
Doesn't it trust the people that it appoints? It is going to hopefully appoint people of unimpeachable integrity. It's just one step removed from the government. It is apolitical. Let these people who are people of high integrity, the former CAG used to be the chair of the Bank Board Bureau, let them appoint board directors. But more important than just the people is make the boards much more responsible for performance. If you've taken away all the responsibility, the boards are just sitting around, and then they're the ones who basically are ticking the boxes that we put in front of them. I would first strengthen the boards, empower the boards significantly more, and that can be done even with government ownership. By all means, the government can still continue to appoint its directors, but let the rest of the board be appointed by the Bank Board Bureau, as well as public shareholders' choice. And then as you strengthen the boards, you can start letting go. I think what we're emphasizing is without governance, without good governance, this is not going to happen.
I'm telling you that this is difficult. I remember a chapter from Dr. Reddy's book, Advice and Dissent. And he is speaking to as banking secretary, speaking to his finance minister, Manmohan Singh. Manmohan Singh asks him to give absolutely unimpeachable people for board directorships. He gives the list. Not one of them is appointed. Why? The party doesn't like these names. So, if you own, you are going to appoint people who are friendly, which is why I'm asking, this sequence has to be first bring down ownership, at least as far as what Dr. Reddy argues. Well, you want to respond to that?
Yeah, I'm just saying you can't bring down ownership without confidence in governance. You simply cannot do that. Who's going to govern the company?
No, I meant 49%. I meant 49% so that, you yourself have spoken about state-linked banks.
Even with 49%, you still have the appointment power of a significant part of the board. So in any case, at some point, you have to let go. And that is where the DFS shouldn't appoint, the government shouldn't appoint, have one step removed, have a set of private and former public officials of unimpeachable integrity appoint. Once you get some strength there, and once you empower the boards more, the boards don't appoint the CEO, for example. Once you empower the boards more, you've got better governance. Now, you're certainly right in saying there's a chicken and egg problem. What comes first? I think you do a little bit on all sides to get it moving towards the point where you're able
Actually, I'm being warned that I have to take the commercial break. That's what we live on. So I want to get some quick comments from both of you before I go into that break. Dr. Acharya, how bad does it get? We've gone through an AQR and seen about, double-digit NPAs, 11, 12%. Do you think we will get away with, more minor bruises this time?
I don't think so. I think Dr. Rajan is absolutely right. RBI's own financial stability report has already projected 12.5 to 14.7% gross NPA ratio in a scenario that's not as stressed as some of the other macroeconomic analysis seems to suggest. And the experience of past episodes of this magnitude is that you have to clean up the banking sector fast and quick. You can't do it in a prolonged manner because then you have 5 to 10 years of weak credit growth, zombie lending, lazy lending, just lending to the government, and so on. So my preference would be that we use this opportunity to fix not just the legacy loans problem, but to also provide well for the losses that are likely to arise. And the only way to do that is to show the world that our banks, especially the public sector banks, can be more profitable than where they are right now. Otherwise, it's going to be hard to get the capital into this.
Well, we have in the past reformed with our backs to the wall. But Dr. Rajan, what are the prospects of these reforms? What are the chances that such dramatic reforms will be done? And also another quick question, how bad do you think growth gets? There are people who say that by FY22 we will get to our FY20 GDP level. Any guesses on how long this downturn can be?
On the second question, I think it entirely depends on how we gain control over the pandemic. Once we do that, we will know better what the size of the problem is. We've just had one GDP reading, and that too probably misses some of the informal sector. And so I think this is anybody's guess to some extent. Let us be prepared for the worst, because I think things are going to get bad. And if it gets better than that, great. We've done some reforms which will help us increase the pace of growth over and above that. I think this is an opportunity to do what is necessary, obviously with adequate deliberation amongst the political parties, etc. But I think we can take major reform steps at this point, and we should, because India really needs a growth reset.
Okay. Well, thank you very much, Dr. Rajan and Dr. Acharya. This is about the best brains trust you can get for the financial sector, for the banking sector, and for the economy. And the doctors prescribe that we should have faster resolution of loans, some institutional mechanisms for that. The paper lists much more. And in terms of ownership of public sector banks, first have very strong boards, and then eventually the government should reduce its stake, and all this be done speedily. We can't wait for normalcy to return. Normalcy will return if we take these steps. We have to take a break. We're going to come back. There's lots more lined up.